again. My name is Semugaya Frederick. I have come to handle Senior 5 entrepreneurship, particularly PP2, financial management skills, the components of final accounts. And last time you said that there are 3: the trading account, profit and loss account, and the balance sheet. Last time we exhausted the trading account. This time round, we want to talk about profit and loss account. We want to talk about the profit and loss account as one of the components, as one of the elements of final accounts. Remember, trading, profit and loss account are the ones that make up what we call the income statement. But we want to first treat them separately. Last time we talked about the trading account. Now let us talk about the profit and loss account. Profit and loss account is a financial statement we prepare to calculate the net profit or the net loss made by the business. What do we mean by the net profit? Net profit refers to the actual profit, to the real profit made by the business. Remember, when we were talking about the trading account, we talked about the trading account as a financial statement we prepare to calculate the gross profit. Gross profit, we say it is the overall profit made by the business before putting expenses to consideration. So the expenses, or what we call the insertion of the business, we are going to consider it here. So net profit is the actual profit or the real profit made by the business. And this net profit, we get it when we prepare the profit and loss account. So net profit, the formula for calculating net profit is the gross profit minus expenses. The gross profit minus expenses, or net profit. The formula is total income. Total income minus total expenses. Remember, expenses are the things on which the business spends money for smoothly running. So when we want to establish the net profit made by the business, we use that formula. Items we consider when we are preparing the profit and loss account. There are basically 2 items we consider when we are preparing the profit and loss account. The first item is what we call expenses. Expenses, these are things on which the business spends money for its smooth running. Some examples of expenses. We may talk about electricity. The business spends money on electricity for smooth running, transport. We have carriage outwards. Some people call it carriage on sales. Carriage on sales. We have salaries and wages. Salaries and wages. We have discount allowed. This discount allowed, some people call it sales discount. Sales. Yeah, it is a price reduction that business gives to its customers. It is regarded as an expense to the business. I may talk about stationery. Stationery, the business spends money on stationery. We may have interest around. The business could have acquired a loan and it had to pay the interest to the bank. That's the interest allowed. We have rent allowed. Some people just call it rent. It is another expense to the business. We have commission. Commission allowed. The commission the business, for example, gives to the salespersons, that commission is an expense to the business. Is that commission allowed? We may talk about depreciation. Depreciation of fixed assets. We shall talk more about the fixed assets when we come to the balance sheet, another component of final accounts. Fixed assets, these are this is a property, or these are things of value owned by the business, but still the business for a long period of time. Take an example of motor vehicles, buildings, land, and so many others. Depreciation of fixed assets. Depreciation refers to the loss of value for fixed assets. When these fixed assets lose in value, what that value is called depreciation. It is regarded as an expense to the business. We have bad debts. Bad debts. Some people just call them bad debts written off. Bad debts written off. The business sells goods on credit, and those people to whom the goods were sold on credit totally refuse to pay the business's money. They run away. So what the business does is write off those debts. Is to forget those debts. But when the business forgets those debts, it means it has made a loss. Okay? There are so many others. Gross loss. If a business makes a gross loss, it is regarded also as an expense to the business. For example, talking about the trading account. You draw your trading account, instead of getting a gross profit, you get a gross loss. That gross loss, when you come to profit and loss account, is going to be recorded under expenses, as we are going to see. And so many others. There are so many other expenses. Okay? So this is our first item that we consider when we are preparing the profit and loss account. It is our first item known as the expenses. The second item that we consider when you are preparing the profit and loss account is known as income. Income or business gains. Incomes or business gains. The source of income to the business. The earning of the business. Where the business gets money from. The business gets money from what we call gross profit. Gross profit is a very good example of a business income. So when we are preparing the profit and loss account, we go to the trading account and get that gross profit. In accounting, we call that one gross profit brought down. So we use it when you are preparing the profit and loss account. It's one of the items that actually help us when we are preparing the profit and loss account, the gross profit. Then we add the other supplementary incomes. For example, we have discount received. Discount received. Some people call it purchases discount. Purchases discount. This is the discount the business gets from its suppliers. Where the business buys goods, it is also given some discounts. Such discounts are regarded as business income, or what we call business gains. We have interest received. The business maybe lent money out, lent some money out, and those people that took business money, as they are bringing it back, they bring it with interest. That one is also regarded as an income to the business. Commission received, the business also participates in a deal. The business sells goods and it is also given a commission. That is the commission received, which is also regarded as an income to the business. We have also what we call rent income. Some people call it rent received. People should not confuse rent and rent received. Rent without the word received, that one is an expense to the business. But rent with the word received or with the word income, that one is an income to the business. The business could be having also houses out there, but where to get some rent. That is an income to the business. The business has houses for rent. What it gets is an income to it. We also have what we call bad debts. Recovered. Bad debts recovered. Yes, you wrote off some debts. The business wrote off some debts. Decided to forget the debts completely. All of a sudden, you see that debt are bringing in the money. The debts are written off. So that is another income to the business, supplementary income, and so many others. And so many others. Those are just a few examples of incomes, stroke gains to the business. So basically, when we are preparing profit and loss account, we use expenses and incomes. Now we want to see how we use the expenses and incomes to prepare the profit and loss account. There are two methods we use when we are preparing the profit and loss account. The first method is known as the horizontal format. Some people call it vertical format. Some people call it T format. The second method is known as vertical format. We want to apply both of them. We want to apply both of them. Example. The following information was extracted from the books of Unyondo Enterprises on 31st December 2004. Gross profit shillings 2 million. Rent shillings 500,000. Salaries shillings 100,000. Carried outwards outwards. Shillings, 100,000. Required. Prepared. Nyondo Enterprises. Profit and loss account. Prepared Nyondo Enterprises. Profit and loss account. Yes, we want to use that example to see how we can prepare the profit and loss account using the two methods I talked about. The horizontal method, some people refer to as T format, and then the vertical format. Horizontal format. Horizontal stroke T format. As usual, when you are preparing these financial statements, you start with the title, and the title must be written in 3 lines. You start with the name of the business. For example, here we have Nyondo Enterprises. Nyondo Enterprises, profit and loss account for their ended. For their ended 31st December 2004. This is how it looks like. We call it T format because it resembles data T. That's why we call it T format. Some people call it horizontal format. It has 2 sides. It has a debit side, DR, and also has a credit side, CR. This is the column where we are going to write our amounts of money, and even inside we shall have a column where we shall write the amounts of money. Here we shall have the details. Even here we shall have the details. With the horizontal format, this debit side is for expenses. All expenses, some people call it SASA. The SASA of the business, the expenses of the business are recorded on the debit side of profit and loss account. Credit side, this credit side is where we record all the incomes, all the gains of the business. Some people call it the needs of the business. Whatever the business gets as income, we record it on the credit side. Now, using our example here, they have given us some expenses and some incomes. I've said all expenses are recorded on the debit side, and all incomes are recorded on the credit side. We want to begin with the debit side, citing out the expenses, speaking out the expenses from this example. When you look at this example, we have rent. Rent is one of the expenses of the business, and we are going to record it on the debit side. Rent they have given us how much money? Rent they have given us 500,000. Rent, shillings 500,000. We have another expense known as salaries. Salaries. All expenses are recorded on the debit side. Salaries, according to the example, we have 100,000 for salaries. Then we have another expense known as carriage outwards. I don't want people to confuse carriage outwards with carriage inwards. Remember, when we are talking about the trading account, we talked about carriage inwards. Carriage inwards, I said, this is the money the business spends on transporting purchases. The money the business spends on transporting goods bought. And we added or we recorded the carriage inwards in the trading account. Carriage outwards, it is the money that business spends on transporting goods sold to customers. Some businesses give what we call free transport. That free transport that business gives to customers is what we call carriage outwards, and it is an expense to the business. So that's why we are recording it here. Some people call it carriage on sales. Okay? So carriage outwards. Shillings 200,000. When you look at the example, our expenses are done. Let us add and give total expenses. 500,000 plus the 600,000 plus 200,000, you get 800,000. And we shall follow that one, total expenses. On the credit side, this is the credit side. This credit side is for incomes. Is what we call supplementary incomes. The needs of the business is recorded on the credit side. And we have one of the incomes. Gross profit is an income to the business. Remember, I told you gross loss is an expense. So gross profit is an income. So we record it on the credit side here. Gross profit. How much money? Gross profit, they gave us 2 million. 2 million shillings. It is the only gross, the only income they have given us in the question. That means we are going to use our first formula. Go back to the first formula. The first formula we talked about was saying net profit is equal to gross profit minus expenses. Gross profit minus expenses, you get net profit. So our gross profit, it is 2 million minus expenses 800,000. 2 million minus 800,000, you get 1,200,000. And that's what we call net profit. And we're going to write it on this other side. 1,200,000 is our net profit. We shall call it net profit carried down. It is the language of accounting. So we try to balance the two sides. If you add these expenses, we are balancing the two sides. Expenses, the 800,000 plus 1,200,000, you go back to 2 million. Even here we have 2 million. And we shall say the two sides are balanced. You don't want people right here other figures, so you put it as a small line. And this is our profit and loss account using horizontal format or using the vertical format. We want to move to another format, another method. Vertical format. Vertical format. Vertical format. Again, we start with the title, Nyondo Enterprises, profit and loss account. For their edit, (31st December 2004). Shillings, shillings, shillings. And here we have details. That is the format of, that is the vertical format. That's how it looks like. This method, this second method doesn't have the debit side and doesn't have the credit side. When you are preparing the profit and loss account using the vertical format, our formula is very important here. The formula for calculating net profit, remember I told you, we prepare, we draw that profit and loss account to calculate net profit. The formula for calculating net profit is gross profit minus expenses, or total incomes minus total expenses. So our first formula, gross profit, net profit is equal to gross profit minus expenses. We are going to use it here. We are going to use that formula here. The first item we are going to record here, it is the gross profit. Why? Because our formula says net profit is equal to gross profit. So according to that formula, the first item there is gross profit. And after writing gross profit, we shall minus the expenses. So we have gross profit, which is 2 million. Then, according to the formula, gross profit minus, in accounting, sometimes you call that minus less. That's why here we are going to say less expenses. We are going to subtract off the expenses. Among the expenses they gave us in the example, we have rent, 500,000. Then we have salaries. Salaries 100,000. Then we have carriage outwards. Carriage outwards 200,000. You add these expenses. When you add these expenses, you get 800,000. 800,000. And remember, the 800,000, it is the total expenses. Total expenses. The formula was saying net profit is equal to gross profit. This is the gross profit minus expenses. The 800,000 are the expenses. When you minus, what do you get? You get 1,500,000. 1,500,000. And that one is what we call the net profit. And that is our profit and loss account using the vertical format. That's how it looks like. That's how it looks like. So the two methods we use when you're preparing the profit and loss account, we have gone through them. I want to give the second example. After that second example, I will give a simple assignment. Given the following information, from Kabito and Sons Limited on 31st December 2007. Transport shillings 100,000. Rent shillings 100,000. Discount allowed shillings 200,000. Discount received 300,000. Rent income. Someone may call it rent received. Shillings 500,000. Talk about stationery. Stationery 100,000. Required prepared Capital and Sons Limited. And Sons profit and loss account. We are using again the two methods, the horizontal and the vertical. Let us start with the horizontal. As usual, we start with the title. This business belongs to Capital. Belongs to Capital and Sons Limited. Profit and loss account for the year ended for the year ended 31st December 2007. Yes, we have the debit side. Again, we have also the credit side. Shillings. Here we have details. Shillings are very important. Never forget to write the units. More so in those columns, we are supposed to write the money. More so we are supposed to write the amounts involved in a particular transaction. This is our profit and loss account for Capital and Sons. We have the two sides, the debit side and the credit side. Debit side, I've already told you, is for expenses. Credit side is for incomes. Now, you go to your example, go to the question. Look for the expenses. I've seen transport. We take it to the debit side. Transport. How much money? 100,000. Another expense, we have rent. Rent has how much? 400,000. Rent has 400,000. Another expense is the discount allowance. Discount allowance is an expense for business. I told you already. Discount allowance, some people call it sales discount, which is an expense for the business. Discount allowance, how much? 500,000. Yes. We have another expense. This discount receipt is not an expense, it's an income. We shall take it to the credit side. Rent income is not an expense, it is an income. As is clearly stated here, we shall take it to the credit side. Then stationery is an expense. And stationery we code it on this other side, the debit side. Stationery, it is 100,000. So that is our side for expenses. The other side for incomes, the first item, income. Yes, there is one item I do not give you here. It is gross profit. Gross profit was supposed to be given. Gross profit. Gross profit. 1 million shillings. It was omitted. Gross profit 1 million. Gross profit 1 million. It is the first item. That item has to be there. So the side for incomes, we start it with the gross profit. We start it with the gross profit. And our gross profit is 1 million. This is 1 million. Then on that very gross profit, we are going to add there other supplementary incomes. For example, we talked about discount received. Discount received, which some people call purchase discount. Discount received. How much money? It is 300,000. Another income, we have rent income. Rent income, 500,000. Now, after recording the expenses on the debit side and income on the credit side, go ahead and get the total on both sides. Let us start with this side, 100,000 plus 400,000, that's 500,000. 500,000 plus 100,000, that's 700,000. Plus this one, plus 100,000, you get 800,000. You get 800,000. 800,000. And that one stands for total expenses. Then credit side, we add together. If you have a calculator, you can use it. 1 million plus 300,000, that's 1,300,000 plus 500,000, that is 1,800,000. Total 1,800,000, and that is called total income. Some may call it gross income. So you go back to the other formula I gave you for calculating net profit. Net profit is equal to total income minus total expenses. This total income, you minus these expenses. 1,800,000 minus 800,000. You get how much? You get 1 million. That 1 million is our net profit. So you get 1 million. And that 1 million is the net profit. Cut it down. You add and try to balance the two sides. The 1 million plus 800,000, you get 1,800,000. Even this side, you have the same 1,800,000. The two sides are balanced very well, and that is our profit and loss account using the horizontal format. Vertical format, Carito and Sons Limited, profit and loss account for the year ended. For the year ended 31st December 2007. Shillings, units are very important. If you don't indicate the units, we shall penalize you in future in exams. We divide your marks by 2 if you don't indicate the units. More so in those columns where we write the monetary values. We are using the same procedure. Go back to the formula. Net profit is equal to total income minus total expenses, meaning that we shall first establish the total income. After establishing the total income, we shall minus the expenses. So according to that formula, let us first establish the total income. How do we get the total income? Total income, we start with the gross profit. Gross profit, they have given us how much? They have given us 1 million. Then we add other incomes like discount received. Some people call these other incomes supplementary incomes. Discount received, I've already told you, which is the same as what it says discount. The discount the business gets from its suppliers. The business gets from where it buys goods. So discount received is 300,000. Then we add rent, income. I'm not talking about rent. If you just rent, that is an expense. But the moment they add the smaller word income, or the moment they add the smaller word received, it ceases to be an expense. It turns into a gain or an income to the business. Rent income 500,000. You add. When you add, you get 1,800,000, and that's our total income. That is our total income. According to the formula, net profit is equal to total income minus total expenses. We are going to less expenses. Expenses given to us, we have transport. How much is our transport? It is 100,000. Transport 100,000. We have rent. That rent, some people call it rent allowed. That word allowed, you come across it, is an expense. Rent allowed. Rent allowed or rent is 400,000. And then we add on discount allowed. Discount allowed, some people call it sales discount. Discount given to customers by the business. Discount allowed 200,000. Then we have stationery. Stationery 100,000. Stationery 100,000. When you add here, you will get your 800,000. And the 800,000 stands for total expenses. Remember, the formula for calculating net profit says total income minus total expenses. So 1,800,000 minus 800,000 you get 1 million. You get 1 million. That 1 million is what we call the net profit. And that's what we call the profit and loss account, using both horizontal and vertical formats. Allow me to write a simple assignment for practicing this profit and loss account. 200,000. Postage, shillings, 100 pounds, shillings, 100,000, sales discount, shillings, 100,000. Salaries and wages. Shillings, 500,000. Required using both horizontal and vertical formats. Prepare Google enterprises profit and loss account. Prepare Google enterprises profit and loss account. We want to combine the trading account with the profit and loss account. I'm giving an illustration of how we can combine the two accounts. Early enterprises, trading and profit and loss account. For their ended December 2002. Allow me to combine these two accounts using the vertical format. The vertical format. Shillings, shillings, shillings. And here we have details. I'm combining the trading account with the profit and loss account. When we are preparing the trading account, we start with the sales, if you are to use the vertical format. Sales, I'm assuming you have finished that. You less returns inwards. You less returns inwards, that amount of money. When you less what you get is known as net sales. According to the formula for calculating gross profit is equal to net sales minus cost of sales. So net sales minus cost of sales. So here you can say less cost of sales. To get the cost of sales, to get the opening stock. Opening stock, that amount of money. You add purchases. You add purchases. This amount of money. Purchases, you may add their carriage inwards. Carriage inwards. You add carriage inwards there. When you add these two, what you get is known as total purchases. Total purchases. Then from total purchases, you less returns outwards. You less returns outwards. When you less returns outwards, what you get here is known as net purchases. It's known as net purchases. Net purchases, if you add the opening stock with net purchases, what you get is what we call goods available for sale. Goods available for sale. This is just a continuation of that. We have our goods available for sale. Now, goods available for sale, you less closing stock. You less the closing stock. That amount of money. When you less, what you get here is what you call cost of sales. Cost of sales. Some people call it cost of goods sold. Now, we are looking for gross profit. We are looking for gross profit. And to get gross profit, the formula is net sales minus the cost of sales. So when you minus here, what you get is what you call gross profit. That is the trading account. After drawing that trading account, automatically add on the profit and loss account. Don't write the title this time around. Just go to those items we used to prepare the profit and loss account. When you are preparing the profit and loss account, the first item you code is the gross profit, and it's already there. And gross profit is the first income of the business. So we are going to add there other supplementary incomes. We add for example, rent income. This is an indicator that we have entered the profit and loss account. Rent income. We can add there, we can as well add there discount received. Discount received. When you add it there, this gross profit plus rent income plus that discount received, what you get is what you call the total income. Total or gross income. Remember, the formula for calculating net profit says total income minus total expenses. So here we're going to say less expenses. Among the expenses we may talk about, we may have salaries and wages. Salaries and wages. With that amount of money, we may talk about transport. With that amount of money, we may talk about rent as well. With that amount of money, we may talk about discount allowed. With that amount of money, we may talk about carriage outwards. With that amount of money. When you add, that's one of the expenses, we cannot exhaust them. When you add, what you get down here is for total expenses. The formula for calculating net income, net profit, is gross income or total income, this one, minus total expenses. So if you minus, what you get down here is what we call net profit. This is the net profit. What you have prepared here, it is the simple illustration of combining the trading account with the profit and loss account. By the way, the combination of the combining of trading and profit and loss account is what people call income statement. Okay? Is what people call income statement. You are not wrong to say that what I have prepared here is income statement. That is the income statement. Next time, God willing, we shall use a practical example. We shall use a practical example and go through the so-called income statement or drawing, trading, profit and loss account, combine it. I wish you the best. May God bless you.